Hey there guys, and welcome back to another video. So if you're new here, I'm Jake and I make these simple investing videos. So in this one, I'm going to be showing you how to set up a custom DIY ETF that beats the S&P 500. So let's get into it. These are the concentrated compounders plus income floor. So the first one is TELUS at 15% weight. The role in it is because it's a yield anchor, rate cut beneficiary. Number two is Enbridge at 12%, dividend machine at 7% yield, Royal Bank at 8%, quality compounder, growing dividends. Number four is AbbVie at 5%, US pharma dividend diversification. Number five is TD at 5%, Canadian Bank, AML overhang priced in. So now we're getting into the compounders. The first one here is Microsoft at 20%, Azure plus Copilot monetization. The second one is TRI at 13%, data and analytics flywheel. The third one is Avgo at 10%, AI A6 King. 49 out of 50 analysts say buy at this price. The next one is CNR at 5%, defensive infrastructure compounder. The next one is NVIDIA at 5%, AI capex cycle, highest upside. The next one is ENS at 2%, covered call income kicker. So the total here is income layers 45%, compounders at 48%, alpha at 7%. So this ETF beats the S&P 500 by doing three things. The index can't. Income floor, the income layer blends to roughly 4.4 to 5% yield, which means you're starting 3 to 4 percentage points ahead of the S&P 500 just on dividends. AI concentration, Avgo, NVIDIA plus Microsoft equals 35% of the fund in the highest conviction AI names. These three already in the S&P 500, but at lower weights, you're just making the bet explicit. Quality defensives, TRI, CNR, Royal Bank, and compounders that tend to hold up in drawbacks, which protects the NAV in rough markets. So I'm just gonna say set up the DIY ETF so it will be less risky and more total returns, choosing 12 to 15 stocks. So I basically edited the ETF so it works a little bit better. So I just said set up the DIY ETF so it will be less risky and more total returns, choosing 12 to 15 stocks. So it says here, this structure is built for lower risk, higher total returns. So the layer one income anchor is at 35%. So Enbridge at 10%, 7% yield backbone, TELUS at 8%, rate cut tailwind income, Royal Bank at 7%, quality compounder dividend growth, Toronto Dominion at 5%, Canadian Bank recovery play, AbbVie at 5%, US pharma dividend diversification. Why the change here? So TELUS dropped from 15% to 8%. That was the single biggest risk reduction move. Enbridge trimmed from 12% to 10%. The saved weight gets redeployed into growth. So layer two, compounders at 42% total. So layer two, compounders at 42%. Microsoft is at 15% now. And Thomson Reuters is at 10%. Avgo at 10%, CNR at 10%, and Fortis at 3%. New rate sensitive utility, low beta anchor. So why Fortis added at 26? So I'm actually 27 with a growth mandate. 3% utility position sounds boring, but Fortis earns its seat by reducing portfolio beta meaningfully and pays a solid dividend. It's insurance. It's not a drag. So layer 3, alpha growth, 18% total. Nvidia at 8%. AI infrastructure, highest 12-month upside. Bank of Nova Scotia. I don't know if I'm gonna buy Bank of Nova Scotia though, because I already have Royal Bank and TD, so I think I might skip Bank of Nova Scotia, even though it says new deep value Canadian bank, or I mean deep value Canadian bank, Latin America growth optionality. ENS at 3%, covered call income kicker. And it says Apple at 2%, but consumer ecosystem, flywheel AI edge hardware. I think I'm gonna own Google instead of Apple though. That's kind of I think Google is a better stock than Apple. So it says I've suggested Apple as a new ad. You'd need to initiate a position, grab a live quote before executing. So it shows here the summary stats. So in version 1 there was only 10 holdings, in version 2 there's 14. Largest single position at 15%. Income layer at 35% instead of 45. Growth compounder layer at 60% instead of 48. US exposure at 42% instead of 40. New additions added. Fortis and Google is what I'm going to add. So the version 1 was income heavy at 45%, great for the 12K dividend target, but income heavy portfolios tend to trail growth in bull markets. The version 2 flips the balance, 60% in compounders and growth, 35% in income anchors. The blended yield drops slightly from 4.5% to 3.8%, but the total return ceiling rises because Microsoft, Avgo, and Nvidia all have meaningful price appreciation potential on top of their smaller dividends. Over a 10-year horizon, that compounding gap is enormous. So if you got any value out of the video, like and comment and subscribe to the channel, and I'll be back for more simple investing videos.